For decades, one single question has been at the center of economic policy. What's the best way to actually grow an economy? So today, we're going to unpack one of the biggest, most enduring debates in all of modern economics. And we're going to do it by diving into the core ideas from Chapter 19 of a major macroeconomics textbook to really get to the heart of this thing. It sounds like such a simple question, right? But the answer has basically split economists and politicians for more than 50 years. Do you grow an economy by empowering the producers, the businesses and investors who create the supply? Or do you focus on the consumers by making sure they have money to spend and stimulating demand? That's it. That's the core of the debate we're digging into. Okay, so let's look at the data that really kicked this whole debate into high gear. Take a look at this. You can see that something pretty dramatic changed in the U.S. economy right around 1973. All the key metrics, things like gross domestic output, which is the total value of everything we produce, and labor productivity, basically how much stuff each worker makes, they all hit a wall. And so did capital formation, which is just a fancy way of saying investment in new factories and equipment. The puzzle for policymakers was obvious. What in the world happened, and how do we fix it? To get to the bottom of this, here's our game plan. We're going to start with the puzzle itself. Then we'll break down the two major competing theories, the supply-side solution on one hand and the Keynesian counterpoint on the other. Then we'll see how these big ideas actually played out in the real world, and we'll wrap up with the fundamental trade-off that honestly still defines this whole debate today. So what time frame are we even talking about here? Well, economists call this the intermediate run. Think somewhere in the ballpark of 1 or 2 decades. And what's tricky about that time frame is that it's a period where both the supply of goods and the demand for them could be the main driver of growth. And that ambiguity right there is exactly where the disagreement begins. So let's start with the first big school of thought that really came out of this economic slowdown, the supply-siders. Their ideas are really rooted in classical economics. They have this core belief in the power of free markets, and let's just say a healthy skepticism toward government getting in the way. The whole supply-side argument really boils down to these 4 core ideas. First, they believe that growth is fundamentally determined by the supply of things like capital and labor. Second and third, and this is crucial, the key to unlocking all that supply is creating the right incentives for people to invest and to work. And finally, that government regulation, more often than not, just gets in the way of all that. Okay, now this is where the supply-side diagnosis of the 1970s slowdown gets really interesting. They argued that high inflation was mixing with the tax code in a really toxic way. For example, businesses could only deduct the original cost of their equipment, not the much higher cost of replacing it down the line. This made their profits look way bigger than they actually were on paper, which led to higher tax bills and, you guessed it, a weaker incentive to invest in new stuff. And they applied the exact same logic to labor, focusing on what they called the tax wedge. You can think of it as the gap between what an employer pays for your work and what you actually get to take home. Supply-siders argue that as marginal tax rates, that's the tax you pay on your very next dollar earned, go up, this wedge gets bigger and bigger, and that shrinks the incentive to, say, work an extra hour or go for that promotion. Now, this line of thinking led to a truly wild idea. What if tax rates were so high that they were actually choking the economy? What if a tax cut could unleash so much growth that the government would end up collecting more money in the end, not less? And this slide right here is the perfect illustration of that theory. This is the famous Laffer curve. The idea is pretty simple. At a 0% tax rate, the government gets $0. But at a 100% tax rate, it also gets $0. Because why would anyone bother to work? The whole supply-side argument was that the U.S. in the late 70s was somewhere on the right side of this curve, in a zone where cutting tax rates could actually lead more tax money flowing in. But as you can imagine, not everyone was convinced. And this brings us to the Keynesian counterpoint. Their whole argument is that looking only at supply is like trying to see the world with one eye closed. As the economist James Tobin famously put it, God gave us 2 eyes so we could watch both supply and demand. This slide really lays out the core disagreements perfectly. You see, where supply-siders see after-tax returns as the key thing for investment, Keynesians look at overall economic output and demand. They would say, hey, businesses invest when their factories are full and people are buying stuff, not just because their taxes are a little lower. And they're way more skeptical that tax cuts actually cause a big surge in how much people are willing to work. So the Keynesian diagnosis of the 70s slowdown is completely different. They argue the problem wasn't bad tax policy, it was all these external factors.
They point to things like the massive oil price shocks and what they saw as overly restrictive monetary policy from the central bank, which basically tipped the economy into recession. From their point of view, low investment wasn't the cause of slow growth, it was the results of it. And when it comes to labor, they'd point to many European countries with much higher taxes that still have lots of people working, which casts some serious doubt on how much tax cuts really move the needle.
Okay, so this wasn't just some dusty academic debate. These two theories have directly shaped what happens in the White House for over 40 years, from the era of Reaganomics all the way to the Recovery Act. Let's take a look at how they actually played out. This iconic quote from Ronald Reagan in 1981, it just perfectly captured the massive shift in economic thinking. It really marked the beginning of an era where these supply-side ideas moved out of the classroom and straight to the center of American policy. And you can really see the economic pendulum just swing back and forth on this timeline. The 1980s were all about Reagan's supply-side policies. The 90s were more of a mix. Then the 2000s under George W. Bush brought a big return to supply-side tax cutting. And then, bam, the 2008 financial crisis hits and you see this dramatic shift under the Obama administration toward a Keynesian demand-focused stimulus plan. So this brings us right to the heart of the matter. This isn't just a technical debate about GDP growth. It's really a debate about our fundamental values. And it forces us to confront a huge trade-off between two things we all care about: efficiency and equality. Just look at this single, stark number, 275%. According to a major Congressional Budget Office study, that is how much the real after-tax income for the top 1% of American households grew between 1979 and 2007. Now, for comparison, during that exact same time, the income for the middle 60% of households, it grew by just under 40%. And this visual just captures the core conflict perfectly. Supply-side policies are really designed to maximize economic efficiency by making market incentives as strong as possible. But the potential downside, the risk, is that this can lead to much greater inequality. On the flip side, policies that are aimed at reducing that inequality might weaken the very incentives that are supposed to be driving growth in the first place. You know, the economist Arthur Oken captured this tension beautifully. He saw capitalism's constant push for efficiency and democracy's constant push for equality as an improbable mixture. They're in this constant but necessary conflict. As he wrote, they need each other to find a balance, to put some humanity into efficiency and some rationality into equality. And that leaves us with the ultimate question. In this inescapable trade-off, this choice between creating the strongest possible incentives for growth and making sure the gains from that growth are shared more broadly, what do we as a society value more? The answer we choose continues to shape our economy and our politics every single day.